Okay, welcome to the Forex class. I'm going to share my screen shortly with us. And in the coming days, I would not only be sharing screen, I'll be taking you to live trading so you can see how people go about doing this. Start from the very basic knowledge of Forex. What is Forex trading? Okay, we're good to go. Forex trading. So let's begin with very basic knowledge of Forex trading. So we usually call it FX, or we call it Forex. Simply means foreign exchange. It's a market. The Forex exchange, also known as FX or Forex market, is a global market space for exchanging national currencies against one another. This class doesn't just focus on currencies. We're also going to be focusing on commodities, securities, futures, indices, cryptocurrencies, stocks. We'll look at all of these areas, and then at the end of the day, you pick the one that you prefer to use. But we want to start with the basic foundation of Forex. So rather than call it the Forex market, sometimes we hear me use the words the financial markets. We're going to delve into the world of the financial market where a lot of money is traded in that space. Trust me, on a daily basis, let me get my facts right. On a daily basis, we have close to, some people say $300 trillion exchange hands. Some people say $500 trillion exchange hands in the financial markets. Billions upon billions of dollars exchange hands in different markets. So the foreign exchange market, which is also known as Forex or FX, is the largest financial market in the world. So we have the stock market, we have other markets, other financial markets, we even have the cryptocurrency market, and the cryptocurrency market is actually catching on a whole lot. But the FX or the foreign exchange market is the largest financial market in the world. Interestingly, the foreign exchange market is a 24/5 market. Usually we say 24/7. That is 24 hours a day, 7 days a week. But the forex market doesn't go that route. The forex market works 24/5, 24 hours a day, 5 days a week. So usually in most markets around the world, they don't work on Saturdays and Sundays. That there's no operation on Saturdays and Sundays. All right, so what is Forex trading? What does it mean to trade? So we understand what foreign exchange is, okay, and the market. So what does it mean to trade? Right? You want to ask me a question?
You were asking what is FX trading.
Any idea at all?
So I'm all ears, sir.
Okay.
Well, I've read more on it, but I'm really enjoying the lesson so far.
Okay, so just follow me. We're going to get to the point where you get to understand a few things, and you understand why I told you to download the Reef. Sent you a link.
Yes,
and
sir.
why I also told you to download MetaTrader 5. I'll explain all of that and what it means. So the foreign exchange market is a global, and I like to underline the word decentralized or OTC market, over-the-counter markets for the trading of currencies. What that means is that it's not the network of banks, and there's really no central bank that regulates the forex exchange market. It's decentralized. That's one of the exciting things about the FX market. It's decentralized, just as much as the cryptocurrency market also is very decentralized. There's no regulator, as it were. So the FX market, exchange market, is a global, decentralized, over-the-counter market for trading currencies, that is currencies of different countries. This market determines foreign exchange rates for every currency. It includes all aspects of buying, selling, and exchanging currencies at a current or determined price. I like to follow my line of thoughts and trend of thoughts I've also recorded. Why should you be involved in the FX market, in the Forex market? What are the benefits? Why should you be interested in that space? Do you think that is a space worth the while? I'll tell you why. The beautiful thing about the FX market, and as you should know, is that you can start with minimum investment of $20, $30, $100. You can start and then grow your equity, grow your asset, grow the asset into something huger by not withdrawing. Just allow it to compound and compound, and then you can grow your portfolio into something as much as, I know somebody who started with just $100 and today he has $24,000 in his equity, something that he's handling a $24,000 project right there with him. But he said with a minimum investment, people make a lot of money from Forex. You can start with even $10, $20. You can start and grow when you know what to do. You can also dedicate time for it and opt out if you wish. What that means is that you can choose, even as a pastor. I know you're a pastor, and if you're a person who have activities, you can come in the evening, and then just look at the market, either use your laptop or use your phone, and then watch the market, watch the charts, and then trade at that period. And once you are done, you can exit the market. One of the persons who taught me financial market and the foreign exchange market says that we should be particular about just choosing to target driven or target based trading. Target based trading simply means that you trade for a while, you make a little profit, and you're out of the market. You don't allow greed to take over you and allow you to lose money and so on and so forth. So another thing you also know about the forex market, why you should also engage it, is because the forex market is recession proof. Because if there's a recession in Nigeria or in Ghana, there's no recession in Japan, there is no recession in Russia, there's no recession in USA. So you can be trading on currencies outside of your own country. Okay, so it doesn't have that, recession doesn't affect it. And then beautifully, you don't need to have any employees or inventory. All you simply need is a laptop, a phone, good phone, and then maybe internet connect. And you need to be in your house. You need to be somewhere that when it's time for you to trade, you're alone. Like for me, I like to trade in the late of the night from 12 midnight. Sometimes I do from 2 p.m. And depends what I'm trading though. I like to just stay and trade down to 3 or 4 like sleep. So you can choose your time of times that you trade in the market. So I want us to, one of the ways to master the Forex market, one of the ways to also master the cryptocurrency market is to understand certain terms and terminologies that will help you to master it. You can also watch videos on YouTube and also read materials on Google that will help you understand what this means. So one of the things we talk about, especially in the FX market, in the currency market, in the FX market, foreign exchange market, is what we call currency pairs. So if you're writing, take that down as a note. What's a currency pair? A currency pair is the quotation of two different currencies with the value of one currency being quoted against the other. That's what the currency pair is, the quotation of two different currencies. So you hear things like Euro USD, EUR USD. That means you always, when you want to trade, you cannot trade on one single currency. You trade on two currencies. If I'm coming to Ghana, I was in Ghana a few weeks ago, and when I got to Ghana, I had to exchange my currency, give the people the bureau de change my naira, and receive CDs. All right, so there has to be a pairing. For you to trade, you're going to trade with the pairing of currencies. That's what we call currency pairs. You cannot trade a currency independently. And the beautiful thing about this is that you can also trade a currency with a crypto. So you see USD, Bitcoin, USD, Binance. You can also trade currency with, you can trade currencies with cryptocurrency. So the first listed currency in the currency pair is called the base currency. I'll show you a graphical representation of that now. And the second currency is called the quote currency. Let's look what I'm talking about. So usually when we're trading, this is how we look at it. We say GBP, that is the Great Britain pounds, slash USD, that's the United States dollars, equals 1.21. That's the fact. That's not current though. That's not current. You have to check the financial market to see what's current. But this is what we mean by currency pair. This is what we mean by a currency pair. GBP slash USD. And GBP is called the base currency, and USD is called the quote currency. So these two are called the currency pair. All right, so there are 7 major currency pairs that we trade, and you see in the financial market, in your MetaTrader 5, very major currency pair when it comes to FX. The first one is called the Euro Dollar, very popular Euro Dollar pair, EUR/USD. The next one is called the Dollar Japanese Yen, USD JPY. The next one is the British Pound Sterling USD, GBP USD. The next one is the US Dollar Swiss Franc, USD/CHF. The next one is the Australian Dollar US Dollar, AUD USD. You have the US Dollar and Canadian Dollar, USD CAD. You have the New Zealand Dollar, USD Dollar, NZD USD. These are the major currency pairs that a lot of traders, Forex traders, like to use them and speculate, because what you're doing basically in the Forex market is to speculate. They like to use them and to speculate with them and to determine how many pips make money from. These are quite popular because the currencies are quite strong. So you may want to capture these 7 major currency pairs. Very rarely do you have our local currencies paired with European currencies in that space. It's not a good market to go to. It's usually very volatile. So another term you want to understand aside currency pairs is the term PIP. What is a PIP in Forex? PIP. So what is a PIP in Forex? PIP is an acronym for percentage in points. Percentage in points, or we can actually call it price interest point. You get to understand what it is. So a PIP is the smallest price move that an exchange rate can make based on the Forex market convention. I'm going to explain that shortly. But you want to write down the meaning of PIP, percentage in points. You hear us use that term a lot. Aside currency pairs, another term we use very regularly is PIP, percentage in points or price interest points. And a PIP is the smallest price move that an exchange rate can make based on the Forex market convention. So let me show you a graphical representation of what PIP means. Okay, it's the smallest amount of movement. It's the smallest amount of movement in the Forex market. I'm going to show you shortly. It's the smallest number that moves in a currency pair. So a PIP is a price move in a given exchange rate. Understanding the change in value helps traders to enter or edit orders or manage their trading strategy. Let me see if I can show you a graphical representation of what a PIP is. Look at the screen very carefully. So this what we have here is a Euro USD. Euro USD. The value of Euro USD is 1.23840. That was enough for you to get 1 euro. For you to get 1 euro, you would have to buy that euro for $1.23840. In order for you to get 1 euro, you need to get 1 euro is a base, is the strongest, is the strong one. You will need to pay 1.23840 to get 1 euro. In order for you to get, in my own country, for you to get $1, you will need to pay 500 naira to get $1. So we're saying, we say USD/NG, USD/NGN, Nigerian Naira equals 500.0000. And then if you look at this point that we have here, you usually would have 1, 2, 3, 4, 5. You usually have 4, not 5, but 4. 4. 1, 1, 2, 3, 4. So the 0.2384 is called the peak. It's called the peak. When you have another extra figure, it's called a pipette. Don't worry, you get to understand it. Now, today you bought USD, you bought euro, you use your dollar to buy euro for 1.23840, but by the following day, it's the price moved. For whatever reason, inflation, whatever, the price moved. Instead of it being 1.23840, it moved to 1.23850. So there has been a movement. The market has, there's a shift. There's a shift. So the difference is called the PEEP. That movement, PEEP is used by traders to show the change in value between currency pairs. So whenever there is a change in currency, a movement, it means that that's what we call a PEEP. Basically, the PEEP is, you get to understand it when we start getting on live chart, when you start looking at your, you say pips. Number, how many pips do you have? 2, 3, 4, 8, 4. And then the fifth one is called the pipette. The pipette is the last decimal of a quotation, usually the fifth one. Now, so like in this case, look at this diagram very carefully. So you have 1.15382. The first one, usually called 10,000 pips. After the point, the next one is called 1,000 pips. The next one, like in this case, now it's 1,000 pips, one is called 500 pips. This one is called 30 pips, 8 pips. Because this is the fifth one, this is the fifth one, is called 0.2 pips or a pipette. Don't worry, as we get to the market, you understand how this applies. But it's important to understand pips. Pips are how many, you hear us use that terminology a lot in the forex market. How many pips do you have? How many pips do you want to make? Use pips to calculate how much money you're making. The movement of prices multiplied by what is called the lot size determines how much money you make in the forex market. So now there's something I want you to also pay attention to. The markets, all markets like the GB, I mentioned 7 currency pairs, GBP, USD, usually have 4 pips. You see in this one, 1.2998, okay? That is, you have 4. 2.2998, that's 4. Usually have 4 figures, 4 decimals, after decimal points. But the only one you have 2 is when you have Euro and Japan, or when you have USD and Japan. For Japan, you have only 2 decimal points. For GBP USD, EUR USD, and every other currency pair, you have 4.4, you have 4 figures after the points. But the only difference is between any other currency paired with Japan yen. Japan yen, you have 2 pips. I'm sure this will be understood. So another term that we also pay attention to when it comes to the forex market is called lot size. So we've talked about currency pair, that's the pairing of currencies. Because you want to get to the market, you cannot get to the market in isolation, you need to have a currency pair, all right? And then the next thing we talked about is pips, percentage in points. And we're saying that the pips is the movement. So if, for example, I bought, let me use my country's dollar, dollar to naira. So USD NGN is equals 500.00000. So that's for today. Then tomorrow, it moves from 500 to 498 naira. USD NGN moves to 498 naira. It means that the pips, there has been a reduction in pips. There's a reduction in pips, 2 pips. 2 pips is reduction in pips. So we'll understand what pips are. Now, the next thing is the lot size. I want you to pay attention to this because it's important. Now, you do not, when you go to the Forex market, you do not trade with your currency, with the currency itself. You don't use money and trade on the currency. For you to get into the market and make any purchase, whether you're selling futures, gold, whether you're selling cryptocurrency, whatever you want to sell in the market, you need to work with what is called a lot size. You give a broker, we'll discuss that shortly. You give a broker your money, and the broker will give you what is called a lot size, equivalent to the amount of money that you're giving. It's with that lot size that you go to the market and you trade. So Forex is commonly traded in specific amounts called lots, or basically the number of currency units you will buy or sell. So you give the money to the broker gives you what is called a lot size, lots, all right? That's what we call lots. So currency pairs are traded in what is called lots. A lot is the amount of currency pair you are buying and selling. So it's like you give them money, they give you a virtual constant thing. And it's okay, this is your lot size. So another thing you see us talk a lot in the Forex market is what is your lot size? Your lot size is very important. When you multiply your pips with your lot size, when you multiply your pips with your lot size, you have the figure you're going to make in dollars. When you multiply your pips with your lot size, you get the amount of money you're going to earn in dollars. These are very foundational teachings and very basic, but they will help you in this Forex market business. Now, so we have lot sizes. The standard size for a lot is 100,000 units of currency. The standard size for a lot is 100,000 units of currency. And now there are also mini lot size, micro lot size, nano lot sizes, okay? The mini is 10,000, the micro is 1,000, and the nano, which is very rarely used, is 100 units, okay? The standard lot size is 100,000. The mini lot size is 10,000. The micro lot size is 1,000. The nano lot size is 10,000. So you buy from the broker, which we'll discuss, lot sizes. Those lot sizes are equivalent to the dollars that you want to make. So the standard lot size in this case is 100,000 units, okay? And then 100,000, whenever you make if you make one pip, let's say USD NGN, USD Nigerian Naira is equals to 500 Naira today, 500.0000. Then that's 17th of April, 2021. 18th of April, 2021, USD slash NGN moved from 500.000 to 500.0001. Move by, so what has happened? There's a movement by 1 pip. There'll be movement by 1 pip. So if I have 1 pip and I bought a lot size from the broker, what's 100,000 units from the broker, I'll multiply that increment of 1 pip by 100,000, one pip by the equivalent in dollars. The equivalent of 100,000 is $10. For every pip there's a movement, multiply it by $10. That means I've made $10 as a profit. So 100,000 units is equivalent to $10. 10,000 units of lot size is equivalent to $1. $1. 1,000 units plus micro lot of lot size is equivalent to 0.10. And then 100 units of lot size equals to 0.001. Don't worry, as you get to understand it, the broker will actually determine the figure for you. But just understand that you don't give money, you don't use your money to trade, you give money to the broker, and then you buy whatever lot size you can afford. And then whenever there's an increment, whenever there's an improvement, you are paid by the number of pips multiplied by the lot size. All right. So, but most people don't have monies to buy a standard lot size. So the next concept we're going to look at in the Forex market is called leverage. Leverage in Forex. What is leverage? It's a term we use very often for those of us who deal with currency pair. When we say leverage, what do we mean by leverage? Now, because we don't have the money, we don't have $1 million to trade, because for you to make good money in the Forex market, you need to put in a lot of money. We don't have a lot of money to invest in the Forex market, so we can go to our broker. And go to explain broker, what a broker is. It's a middleman. It's like the banker of the Forex market. You go to your, like in the case I told you to download a certain app or to click on the app and register, that is called the RIF. The RIF is a broker. The RIF is a broker. There are many other brokers. There's KOT. We'll look at that shortly. But if I don't have the resources to play in that market, I can tell the broker to give me extra lot sizes, so that I can trade with a higher volume. Leverage is the use of borrowed funds to increase one's trading position beyond what would be available from their cash balance alone. So it's allowed in the Forex market for you to borrow, and that process is called leverage. Forex traders often use leverage to profit from relatively small price changes in the currency pair. So if you have higher amounts of money to play with, when there is a change, a small price change, when there is a little pip, because you have lot sizes high, when you multiply it, the amount of money you're going to make will be high. Leverage, however, can amplify both your profits and losses. So what happens basically is that, yes, you can make profits, but also you can also lose. So leverage has its own strong points and also has its own negative points. All right, so what's the best leverage to use in Forex? Some people say 1 to 100 or to 1 to 200. It's agreed that 1 to 100 or 1 to 200 is the best leverage ratio. Leverage 1 to 100 means that $500, that with $500 in your account, pay attention now, leverage 1 to 100 means that with $500 in the account, in your own account, the trader has $50,000 of credit funds provided by the broker to open trade. So it's like the instead of $500, you are now trading with $50,000 worth of lot sizes, and then you can go into the market space and trade with that. It's so whenever you make any profit, you multiply it by 100. You multiply it by 100. Whenever you make any profit, multiply by 100. When you make any losses, you also multiply it by 100. All right, so leverage represents something like a loan, a line of credit. Brokers, again, that term is coming again. Brokers extend to their clients for trading on the foreign exchange market. If brokers offer you 1 to 500 leverage, this means that for every $1 of their capital, traders receive $500 to trade with. So there are times when brokers give you and you can ask for it in the currency market. It has its own positive and it also has its own negatives. So another term I want to discuss in the Forex market, which I need to pay attention to, is called margins in the Forex market. What is margin? What is margin? Margin is the amount of money that a trader needs to put forward in order to open a trade. In order for you to um, to start trading, you need to put a certain amount of money. Even when you have leverage, you need to deposit a certain amount of money. That's one definition of margin. So they give the money, you give the money to the broker. That money you put forward to open a trade is called your margin. That's one definition of margin. There's another definition of margin. Margin is the amount of money that a trader needs to put forward in order to open a trade. When trading Forex on margin, you only need to pay a percentage of the full value of the position to open a trade. So what you do basically, what that means is that if, for example, you get leverage of $500 or $50,000, you need to still put down, you need to give the broker $500. You need to give the broker five. That money you give to the broker is called your margin. That money you give to the broker is called your margin, and you use that money to open a trade. The leverage available to a trader depends on the margin requirements of the broker. So there are some brokers that will say that, I can't give you higher than this. So you negotiate your margins with your broker. And if you've been trading with your broker for a while, the broker can give you bigger leverages and allow you to pay not as much margin. So your margin is what you put down in order for you to open a trade. The leverage available to a trader depends on the margin requirements of the broker or the leverage limits as stipulated by the relevant regulatory body. Each nation has, or each regulatory body for brokers, I'm sure there are regulatory bodies for brokers have this and that before you can get leverage. So now let's get, you've heard me use the word broker, broker, broker. We've talked about currency pair. We've talked about lot sizes. We talk about pips, and I'm sure this is recorded so you can watch it again to hear what I've said. You can also check out some other YouTube videos or to get it clearer. We talked about pips, we talked about margins, we talked about leverage. Now let's talk about another very important thing is who and what is a broker. Who is a broker? What is brokerage? Now, I told you to download the read. There are many other brokers, but let's look at the textbook definition of who a broker is. A broker is a place where buyers and sellers go to buy and sell instruments such as currencies. The forex broker operates as a middleman between you and the market. So the reef that we bought is the middleman, is a middle man for MetaTrader 5. Reefs mostly trades on commodities, securities, and indices. Don't worry, you'll get to understand all of that in the future. The Reefs mostly trade on those. If you want to trade on currencies, of course, you can directly use MetaTrader directly, or you can look up for other reliable brokers, like I'm going to make a list of them that you can work with in order for you to do business. So a forex broker is a financial services firm that offers its clients the ability to trade foreign currencies. Foreign is a short for foreign exchange. So a broker is like the middleman between you and the markets. And you've got to be careful about what kind of broker you need. Do you need a broker for Forex? Of course you do. All retail Forex trading, because we have people who do Forex at a very huge level, bankers and so on, big organizations, countries. And then we also have people like you and I who do it at a retail level. Because of the amount of money we have, little amount of money we have, we most times need leverage, and sometimes we need the brokers to add up for us. All retail Forex trading goes through and is managed by a brokerage. Some may be specialized Forex brokers, or they might be the same brokerage you use for the stock market investing and trading. All right. So how do Forex brokers make their money? The main source of the income are broker fees. So in the course of when you make money, they're going to take a percentage, and there's also a broker fees. Some Forex brokers will charge a commission per trade. So every time there's a trade, You're buying lot sizes, there's a percentage you're going to get. When you make some money, there's a percentage you're going to get. While others will charge the spread between the bid and the ask prices. I want to underline the word bid and ask prices. These are also very important terms in when it comes to the forex market, and I want you to search that out. Okay, so when we say a bid price, we're saying that the price in which you sell the base currency, the price in which you sell the base currency. When we say the ask price, we're saying the price which you buy. The bid price is the price in which you sell the base currency. The ask price is the price which you buy. The difference between the bid price and the ask price is what we call the spread. I'll discuss that later. The difference between the bid price and the ask price is what we call the spread. But just get acquainted with these terms. When we go to the live market, you get to understand what we're saying and how you can apply it. The main way that forex brokers make money is by keeping the spread or changing a set of fee per round. So every time you do any transaction, the brokers make money. So you have a lot of brokers asking you, come do business with us, come and do business with us, come and work with us, come and let's work with you. It depends on what you're trading. So brokers in forex trading is good. It's a good idea to choose a large, well-known forex broker. Like there are few forex brokers that are amazing, that are huge, very huge, that you can use, and they are reliable. Forex Capital Markets, FXCM, is a good broker. City FX Pro is an affiliate of Citibank, also a good broker you can use. Think or Swing is a division of DT Trade, also a good broker. But I've told you that we're using the Reef because the Reef helps us to sell indices. We understand indices is a financial instrument, indexes are a financial instrument that you can use to also make money in the financial world. Now, it's also very important that you understand your investment style. Understanding your investment style can help determine which FX broker will be best for you. All right, that's also very important. You also want to compare commission rates between brokers. You know, transaction costs are an important factor in the profitability of the trading activity. So you're not making money at the end of the day because they gave you leverage. You're not able to make substantial amount of money from it. That will likely be dependent on your broker. Okay, so this in 2021, these are the best brokers. Research has it. IG, you say it's the best of all. You know, can check out Saxo Bank, CMC Markets, Interactive Brokers. There are many of them. You can just check out for brokers. TD Ameritrade, Ameritrade FX, City Index, SCB, Forex.com, eToro, all of them. These ones are copy trading platforms. They all have their own strengths. What is a broker? A broker is where, you know, the person is the middleman between you and the market. You don't trade directly. You trade through a broker. You give the broker your money. The broker gives you lot sizes. You use that to trade in the market. In this case, MetaTrader 5. I told you to download. So how do they make their money? From the percentages you make and from the leverage they give to you. That's how they make their money. Now, having discussed those things, I'm going to stop here today, but I won't stop until I discuss this part. This is where you start making a lot of money. If you don't understand this, you will not make money. It's not just about going to the platform and then, you know, opening a trade and then wishing yourself luck. For you to really trade in the forex market, in the financial markets, you need to understand these two. We call it TA and FA. What is TA and FA in FX? Let's start with TA. TA simply means technical analysis. It is the study of the price movement on a chart of a particular forex currency pair or other markets. So what we do, there is the MetaTrader 5 is the market. You will see a lot of candlestick patterns. You will see a lot of charts in the MetaTrader 5. The first thing you see in the MetaTrader 5, you see quotations, EUR/USD. You see different quotations. And then when you click on the next point, I'm going to, when it's practical, when I'm using my mobile phone, I'm going to show you how that works in the future. When we start looking at MetaTrader 5, and how to open a trade and how to close a trade, you're doing currencies. The next thing that you also see is that you see something like this on my screen, like a chart with movements, some going down, some going up, going down. So technical analysis is your ability to study these candlestick movements, the going up, the cresting and the troughing of these things. You use those things using indicators and trend lines. You use all those things to determine your entry decisions and your exit decisions. Use those things to determine how much, when to buy and when to go out of the market. So technical analysis, we can think of technical analysis, or T for short, as a sort of framework that traders use to study and make use of price movement of the market. So you don't make any decision. A lot of traders do technical analysis, all right? So they look at the chart, they can look at the charts within the time frame of 1 day and see, okay, because one of the philosophies we have in the FX market is that history repeats itself. People's buying and selling decisions from yesterday, they will repeat themselves in different markets. So we look at the patterns and we observe a few things before we make a few, before we now choose, okay, I'm going to buy here, I'm going to sell here, and all of that. So don't worry, you get to understand as we begin to trade. Technical analysis is important. There are some traders that all they do is just study. They're so good at studying using technical analysis. And the other people who don't use technical analysis, what they do basically is they do fundamental analysis. So in technical analysis, we use what is called indicators. Don't worry, I'll show you in the MetaTrader 5 app that you have on your phone how to use indicators. I'll also show you how to observe price actions. There are certain people who are traders who prefer using indicators and trend lines before they make any decision, before they announce, okay, I'm staking, I'm speculating, I'm opening a trade here. But there are also people who like to use a naked chart. Don't worry, I'm going to explain what naked chart means to you, and they just use price action. So technical analysis basically is for people who are short-term traders or scrapers or day traders. That's what those are people that use it. So short-term traders mean that they want to just make money. They want to make 10 pips. They want to make 5 pips and get out of the market. They want to get to the market in 5-10 minutes, make a little price increase, make some pips, and then exit the market. So those who want to do that, who want to make quick money, if a day, 2 days, 1 hour, they do a lot of technical analysis. And then you also use technical analysis to determine your stop loss. You understand what that means shortly. And this you can only understand it when it's practical. With the stop loss icon, you put in your stop loss. That means if the price goes down to this point, stop, don't take my money again. Let my loss be, let me not lose more. So you can set it in your MetaTrader 5 market when you're doing your analysis, and when you're setting up, you need to do that so as to prevent yourself from losing more money than necessary. We call it risk management, stop loss. Also, you can take profits. Okay, if it gets this amount of money, let the system automatically take the profit for me. This can be automated with the MetaTrader 5. So these are the things that happen when you do technical analysis. Technical analysis is when you use past performance to predict trades. I like to say that one of the things that we do in the financial markets, whether it's the cryptocurrency trading, because cryptocurrency also has a trading platform, Binance. I use Binance when I'm doing cryptocurrency. We use MetaTrader 5. This is MetaTrader 4, now it's MetaTrader 5, which I recommend. So you can study the charts, and by studying the charts, you now know how to, by studying the charts, you can now predict, oh, this is what will happen in the future. you get to understand candlestick patterns. When I teach you, the next time I'm going to teach you candlestick patterns and how to use it to speculate and determine what might happen so that you can prevent yourself from losing. I told you to use a demo account. The reason why you're using a demo account is because you can make your mistakes on demo accounts. You can experiment with demo accounts. You're actually giving 100,000 to play with in a demo account. You can try again and again, and even if you lose, that will not be a bad thing. All right. So you can also use price action to determine when to open a trade, when to enter the market, when to leave the market. I can also use technical indicators. You get to understand indicators shortly. So if you look at this diagram, you see a lot of green and red stuff. You see downtrend, you see range, you see uptrend. So let me just give you an overview about when you look at these charts, what to understand. Whenever you see green, yes, these things are called candles. Those lines are called candles. When you see that, we call it the bullish, bulling, ish, bullish. That is a bull, the face of a bull. Oh, the market is bullish because of the green candles. It means that people are buying the currency more. People are buying the currency. And by the way, the MetaTrader 5 is just a revelation of people's emotions. Their greed, their decision making is reflected in the MetaTrader 5 chart. You see it happening per minute, per second, per hour. It's moving up and down. People are making buying decisions. People are exiting the market. So when you see a green candle, it means that the market is, most of the time, the market is bullish. When you see a red candle, it means that the market is bearish. Bearish means like a bear. It means that you have more sellers. People are selling more, maybe because they are afraid or maybe they want to exit the market, they are selling more. So people don't when you have more red, it means that people are losing, the market is falling. And when you have green, that means the market is rising. That's just a general rule, but as you get to understand candlestick formation, it doesn't always follow. Like if you look at this diagram we have here, you notice that even though you have green, the market was still going down, and then it still rose up. The green made it go up. The green here also made it go up. Even in between the red, you still have some green stuff. All of them have their meanings. Then you look at this red and blue line, and they say downtrend. Every time those candlesticks starts to go down, we call it trends. That's the trend. That's what is happening in the market, is downtrend. Whenever the market is going sideways, you can look at the chart and you see that, oh, it's called sideways or range. It means that the market is stable. The price is not going up and down. If you look at the end here, you see 0.670 and so on, so many figures. That's actually the price. The base is the time, the timing. The down base here is the timing. And you see another one, uptrend. When you have more greens than red, it means that it's bullish, and we call it uptrend. So we have three kinds of trends. We have downtrend, range, and uptrends. In the future, you get to understand what support is and what resistance is. I'll get to explain that to you. So I said something about indicators. Indicators enable you to study this candle, look at the candlesticks again, study them, to place a line, to draw a line, to check them out. They are like that kinds of calculations which some people have put in the MetaTrader 5 that can enable you determine what will happen, because we speculate in the market. That's what we do. And examples of technical indicators are oscillators, volume measures, and MAS. All right. Now, aside technical analysis, a lot of traders do technical analysis, and they use that to make money. They use that to make a lot of money. But there's something called fundamental analysis. So CA is technical analysis, FA is fundamental analysis. while TA focuses more on the micro details of what happens in 5 minutes, what happens in an hour, what happens in a day, in a week, in a month. Fundamental analysis is more macro. It takes into cognizance economic events. So an election happens in a country, in America, and it affects the FX market. People like Warren Buffett, they rarely ever do technical analysis. Hedge fund managers who manage huge portfolios for organizations and banks, because they have to make profit for their investors, and they trade on short time, they trade and exit the market, sell, buy and sell, buy and sell. So those ones do a lot of technical analysis. But those people who do large, who want to do for countries, who want to do for years, 2 months, 3 years, yearly records, like what Warren Buffett does and many other people, financial investors, they do a lot of fundamental analysis. They take into cognizance economic events, they listen to the news a lot. So mostly fundamental analysis is for trend followers. Sorry, that's a correction, long-term traders. Now, so there are people who favor technical analysis and there are people who favor fundamental analysis. And I would say that you can both do technical analysis and fundamental analysis. Even unemployment, the level of inflation, fundamental analysis puts into cognizance the GDP of a country, the inflation of the country, the macroeconomic factors, the interest rates, unemployment, all of that affects, the currency, whether it to be high or whether it to be low. There was a time in my country when $1 to a naira was 500 naira, was 150 naira. Today it has risen up, up because of inflation, many factors, unemployment, all of that truly affects. And people study news. Sometimes you're watching the news, you're looking at the news, and just because we're news, you go and look at the charts. If you go and look at the chart, you see that the news has affected the charts on the MetaTrader 5. So fundamental analysis uses available data to gauge values. So people who take action, like there's this thing I learned some time ago about, I don't know what that name is. Let me see if I can find that name. There's this particular, I can't find that name now. But these guys, they release a news every Friday about the employment rates or indices in America every Friday. And there's some fundamental analysis fundamental analysis traders who wait for Friday. So when they look at the figures released, they will use the information they have there to choose and place the trade. So that's how fundamental analysis works, and a few things. So when we talk about fundamental analysis in summary, these are 2 ways to trade in the Forex market, which you must use. Please don't start trading, else you'll be gambling. You can either do what is called fundamental analysis, that is company analysis, industry analysis, future profit outlook, economic conditions determine how profitable and whether you should buy a company. Even when you're selling indices, when you're buying indices or you're trading with indices, you have to look at these things before you make a buying decision. It's okay, I want to buy this. Let's say you're doing something like, I'll discuss that later, NASDAQ. There's something called NASDAQ 100. That is stocks of 100 non-financial companies in the NASDAQ exchange market. Don't worry about those details. You need to do some of your fundamental analysis before you start trading. And then technical analysis uses indicators. Indicators uses moving averages, indicators, oscillators, and charts. All right. So I already talked about indicators. Forex technical analysis indicators are usually used to forecast price changes in the currency market. They are calculations which take the volume and price of a certain financial instrument into account. By using Forex indicators, traders can make decisions about market entry and exit. So what are the types? You look at this chart here, you see a yellow line going up, up, up. That is an indicator that, if those lines are not there, if those wavy lines are not there, it means that the market, the chart is naked. But once there are lines, you can put these things to determine the uprising and the downfalling of the market by studying it. So what are the types of indicators we have? I already gave you some, but I'm going to give you, you don't need to know all of them. For those of you who are really very interested in technical analysis, and you should be, so that you can make very good decisions. That's what makes you a sharp trader. That's what makes you a successful trader. You start understanding indicators. Use indicators. Indicators work, and sometimes they don't work. You can use other indicators, and they don't work. That some people say that is balderdash. But the other people say fantastic helps you to make very informed decisions. So we have examples of indicators like stochastic oscillator. We have moving average convergence divergence, moving average convergence divergence. We'll look at these things later when we start discussing indicators, MACD. We have Bollinger Bands. Don't worry about these things. They're just there to help. Don't worry, you get to use them. And as you study, you don't learn Forex in a day. As you keep using, as you keep engaging the market, you will understand it better. Relative Strength Index, RSI, Fibonacci or Fibonacci retracements. That's another term you need to understand in the Forex market. What do you mean by retracement? Ichimoku cloud, standard deviation, average directional index. These are just indicators. They are tools we use to determine the price movement in the MetaTrader 5. Again, so I already discussed what trends are. Look at that diagram. You see when it's low, when it's high, low, those movement up and down is what we call trends. People's buying and selling decisions moves the market. People's buying and selling decisions moves the market. A trend is the movement of the market. Trust me, trends are so important and you need to pay attention to trends. Like we have three types of trends. We have uptrend, we have downtrend, and we have sideways trend. I already discussed that with you, and that can affect how much success you achieve in the market. We're going to stop here today, and then when we meet again, we are going to make sure that we start studying, doing more technical analysis. We'll start looking at candlesticks in the financial market. Those things you see, all of them, those things you see here, all of this stuff are candlesticks. We're going to understand, break it down, and see their implication. We'll look at doji, dragonfly, gravestone, 3 black holes, 3 white soldiers, all those terms. Get to understand how to look at them and how to interpret them in the charts. Look at it, interpret them in the charts, and then engage the market. So the assignment I'm going to give you right now is to make sure that you have set up you have set up your Deriv. Download Deriv app on your phone, or you have it on your laptop, and then you should also have downloaded your MetaTrader 5, okay, on your phone, because when we meet again, aside having conversations, we're going to go into practically looking at the MetaTrader 5 and seeing how they can help us. I hope you got value today. This is just fundamental. If there's any other basic knowledge,
very, I have. Yes. so simplified. I've already set up the MetaTrader 5 and the Deriv already.